Happy New Year, Romain. Great to see you.
Likewise. Let's start off with what kind of year we expect here for oil. We're camped out right now, at least on WTI, around 76 bucks a barrel. I've seen some pretty aggressive forecasts that say we could get over $100 a barrel this year. Do you see that?
I don't. So I think there are a lot of structural kind of tailwinds for crude right now. The first being demand has held up really well, even through another variant of COVID, Omicron. So demand looks really strong. Supply looks constrained. So on that level, yes, you do have a nice setup. But to get crude above $100 a barrel, it would be really hard to do that in an environment where we have growth at 4 to 5% on a global basis. It would need to be much more significant than that to kind of outstrip the supply that's available out there, whether it's from OPEC Plus or the US. And I think you mentioned something really key as we look forward to 2022 is the dollar. It's really, really rare for crude to breach above $100 a barrel in the face of dollar strength. So I'm not a dollar expert, but if we continue to see dollar strength, that's going to continue to kind of keep that upside tail event of crude busting through $100 a little bit mitigated. So I think when I look at it, I don't see a crash through, back to the 50s. I see this really nice, healthy range, 70 to 80, maybe a little blow off if I had to say some upside through 85, but I just don't see that massive tail event.
Talk to us more about the supply issues that you mentioned there. You mentioned OPEC Plus. What role does the U.S. play as well in terms of increasing and adding to supply? Why haven't we perhaps maybe seen some of the U.S. producers take advantage of these higher prices?
So I think this is one of the critical questions that I think a lot of us in the oil community have been talking about is why hasn't it come back? And I think it boils down to several different things. First, investors are demanding different types of returns from oil companies. They do not want growth at all costs. They want return on capital, dividends, free cash flow. And so that has pushed investment teams that might have been more aggressive to go out and produce more oil in an environment like this to really rein in. And I think that's been a challenge. And I think the other thing we're seeing is as we have this transition to renewable energy, the excess capital that might have gone to fossil fuel producers, whether it be private companies or even public companies, you're just not seeing that availability of capital. And that, again, has put a little bit of a lid on the exuberance that we might have seen in the past on U.S. production. So I think it's kind of twofold. It's a sentiment issue and it's a demand from investors.
Talk to us about the supply issue, not just in the U.S., but OPEC Plus, of course, meeting tomorrow. And what are we anticipating to be discussed in terms of the way in which they curtail production in what seems to be a supply, focused market when we're worried about demand on the Omicron side?
Yeah, so OPEC Plus tomorrow is expected to bring back 400,000 barrels of crude in February. It's a meeting in January for February. The caveat here, and this is what I think is kind of missed at times, is they've not brought back their full allotment of crude on any occasion that they've increased over the past 6 months. So they've been kind of saying they're going to continue to increase, which has been a signal to the market that they're committed to the path. They don't see a lot of downside risk, even with Omicron. But in the reality of what they do versus what they say, there's been a little bit of a, disassociation. So we haven't seen them bring back all of the crude they can. And I think that will continue because some of the producers simply can't do it. And we look at Nigeria in that particular boat, and we look at a couple other smaller producers. And then secondly, I think they are not necessarily overeager to bring back too much and maybe put some weight on the market. So it's a difference between what they say and what they do, which I think is actually more telling as we look forward in terms of their action.
Let's talk about some of the pressure, though, that the U.S. government has tried to put on oil prices and, for that matter, gas prices. I mean, we're sitting here something like 30% above where we were pre-pandemic with regards to gasoline futures, at least. There was, of course, the great Strategic Petroleum Reserve release, which I'm not sure had any real impact here, Rebecca. What sort of effort, if at all, impact, I should say, can the efforts by the Biden administration have on keeping oil and gasoline prices down?
Great question, Romaine. And so there's two things. I think on the SPR, the fact that we said we were going to release 65 to 80 million barrels out of a global SPR release, U.S. and other countries, we really haven't had a lot of uptake of that. We've had 5.8 million barrels that has been kind of tendered off that release. So it actually hasn't resulted in that much crude hitting the market. However, it was symbolic that the Biden administration is willing to take action to kind of keep a cap on prices. So the bottom line is, I think when we look at what the Biden administration's real tools are, it's more about this political pressure and this negotiation and kind of keeping the market from panicking about the lack of supply, as opposed to being able to actually, in real terms and in very quick fashion, bring crude back to the market. So it's more posturing and less about real barrels is the way I see it. Now, that doesn't mean that things can't evolve and they can't kind of move away from their renewable energy transition stance and try to help U.S. producers become more aggressive in drilling crude. But I think that's pretty unlikely in the near term.
I do this question for our very British Caroline Hyde, Rebecca, who's been very closely following the gas market over there in Europe. And the takeaways really from the transition and maybe the messy transition to cleaner fuels, does the U.S. have a role to play in helping that supply constraints perhaps in Europe?
Yeah, so that's a tough one. And I would say this. I think we'd want to play that role because the ARBs are so incredible right now. If you look at Henry Hub versus where European gas is trading, we would love, U.S. companies would love to capture that and play a role in helping. But the fact is the infrastructure is not there to do that en masse yet. And so, yes, I think what I think you're really asking is conceptually, when we look at the transition, how do we take a transition that right now is fragmented across like a global community that's putting resources in different places versus a market that's globalized? So we're kind of battling that right now. And I do think it would make sense for us to come together globally to try to fill in some of these holes. But again, that's all big talk, kind of how renewables has been, and really hard to achieve. So I think we can talk about wanting to play that role, but until the infrastructure is there and until someone can make money doing it, it's unlikely.